What if the pension you've depended on for decades could be slashed, literally overnight, by clauses nobody ever bothered to point out? You spent your career ticking boxes, meeting eligibility rules, and imagining that reliable monthly check arriving like clockwork. But tucked away in the fine print are hidden triggers, cost of living caps that freeze when markets wobble, reduction factors that impose permanent cuts if you claim even slightly early, and offsets that claw back hundreds of dollars for part-time gigs or social benefits. Imagine turning 65, thinking you've mastered the timing, only to log into your account and see a smaller payment than promised. No warning, no appeal, just a line in the agreement that says the plan can pause or shrink your benefit when funding dips below a threshold. Worse yet, many retirees find themselves steered into survivor benefit options without realizing those guarantees slash their own income by significant percentages. And if you miss the narrow window to choose a lump sum versus an annuity, that decision is set forever, regardless of how your circumstances change. It's not fear-mongering. It's the reality of modern pension plans that juggle rising life expectancy and volatile markets by shifting risk onto beneficiaries. In this video, we're exposing 6 pension clauses that have already caught thousands of hardworking retirees off guard, and showing exactly how each one can erode your hard-earned security. You'll hear real stories of people who thought they'd covered every base, only to discover months later that their payouts were quietly docked. Stick with me, because understanding these pitfalls could mean the difference between living comfortably on your terms or scrambling to make ends meet when a hidden rule comes calling. Don't let surprise cuts hijack your retirement. Learn what to look for before your first check ever arrives. Cost of living adjustments are supposed to be your shield against inflation. Those yearly increases that keep your pension check from shrinking as prices rise. But what many retirees don't realize is that COLA in pension plans often comes with strings attached. You might see language promising annual cost of living increases, but hidden further down you'll find caps, sometimes at 2% or 3% per year, that barely keep pace with today's inflation. Even worse, some plans include freeze provisions. If the pension fund's financial health dips below a certain threshold, those increases vanish altogether. Imagine budgeting your expenses around a promised 3% boost, only to discover, mid-year, that your check will stay flat because the plan's funding ratio fell under 80%. Suddenly, your purchasing power takes a real hit, and you're left scrambling to cover rising rent, groceries, or medical bills with the same old dollars. Real-life cases span coast to coast. Retirees in Ohio saw their COLA frozen for 3 consecutive years after market downturns, while a New England teachers fund capped increases at 1%, even as local living costs climbed nearly 3 times higher. These caps and freezes aren't always shouted from the rooftops. They're buried in summary plan descriptions that few read in full. And when those triggers activate, there's little recourse. The plan administrators point back to the fine print and move on. That's why the first step for anyone approaching retirement is to dig into your plan's exact COLA language. Look for maximum percentage limits, minimum funding triggers, and whether discretionary increases can be withheld entirely. Because if you assume cost of living means keep up with reality, you could find yourself on the losing end of a silent freeze, watching your standard of living erode year after year. But understanding this clause is only the beginning. Next, we'll uncover how early retirement reduction factors can permanently shrink your base benefit in ways you never imagined. Deciding to start your pension just a few months early can feel like a harmless shortcut. But most plans impose permanent reduction factors that shrink your monthly benefit for life, and the math is more punishing than you think. Every pension includes what's called an early retirement reduction factor, often calculated as a percentage cut for each month you're under your plan's defined retirement age. For example, if full benefits kick in at 65 and you begin at 63, you might face a 0.5% reduction per month, adding up to a 12% cut off the top of what you'd otherwise receive. That's not a temporary discount. That smaller check is locked in forever. In many cases, the reduction rate accelerates the further you deviate, Someone retiring 5 years early could see their benefit slashed by 30% or more. And it doesn't stop there. Some plans apply actuarial adjustments that account for life expectancy, meaning if you retire early and have already drawn from your fund, the plan assumes you'll collect longer and reduces each payment accordingly. What feels like a few extra dollars in your pocket up front can translate to tens or even hundreds of thousands of dollars lost over your retirement horizon. Retirees we've spoken to often share the same regret. They underestimated how quickly small monthly penalties compound. They thought, I'll start collecting early and make up the difference by saving elsewhere, only to discover the gap widened as markets fluctuated and costs rose. Worse, if your plan's documentation buries the reduction table in an appendix, you might miss how steep those percentage cuts can be until after you filed for benefits. Before you hit that apply button, run the numbers against your full expected lifespan, not just the next year or two. Because unlike a temporary loan, an early retirement reduction travels with you until the end, permanently eroding the income you spent decades earning. And that's a cut you can't undo once the checks start arriving. When you elect a joint and survivor pension option, you're promising that your spouse or another beneficiary will continue receiving payments after you pass away. It sounds noble and protective, but it comes at a steep cost. Your own monthly benefit will be permanently reduced, sometimes by as much as 50%, to fund that survivor stream. And the exact reduction is rarely transparent until you're filling out the paperwork. Some plans use a flat percentage cut, say 30% off your single life amount, while others apply a sliding scale based on age differences between you and your spouse. If your spouse is significantly younger, the plan assumes it must pay out longer, so it slashes your income deeper. For example, a 65-year-old retiree married to a 55-year-old could see a 40% reduction under the assumption that the plan will be paying a survivor benefit for potentially 2 more decades. Many couples never grasp the math behind these offsets. They pick the joint option out of fear of leaving their spouse unprotected, only to discover their own lifestyle budgets can't keep pace with the cut. Widows and widowers we've heard from regret not testing pop-up options, clauses that boost survivor benefits if both partners pass simultaneously, or exploring term-certain guarantees that protect each other for a fixed period rather than for life. Even worse, some plans automatically default to the joint and survivor form without fully informing participants of the reduction rate, leaving retirees stuck with a smaller check than the one they thought they'd earned. The takeaway: before you sign that election form, demand the exact percentage and run lifetime income projections under both single life and survivor scenarios. Talk through it with your spouse, factor in their own financial resources and Social Security survivor benefits. Because trading half your benefit for a survivor guarantee might feel like the safe choice today, but it could leave you and your partner strapped for cash when you least expect it. If you think picking up a few extra hours consulting or drawing your Social Security on top of your pension sounds harmless, think again. Many public sector plans dock your benefit dollar for dollar once you exceed modest earnings thresholds. It starts with the earnings offset. Your pension plan may allow you to work in retirement, but if you earn even $10,000 over the set limit, sometimes as low as $18,000 per year, you could lose $1 of pension for every $2 you make above that. That seemingly fair trade-off quickly becomes a financial trap when your side hustle check evaporates half in offset reductions. Worse still, some plans integrate Social Security benefits into their formula, reducing your pension by up to 2/3 of whatever you receive from Uncle Sam, a double hit that few anticipate. Imagine counseling sessions billed at $150 an hour, but effectively netting only $50 once offsets kick in and taxes are withheld. Retirees find themselves in a weird limbo where working more actually shrinks their total income. And these offsets aren't always transparent. Plan summaries often bury the threshold tables in fine print, and you only discover the clawbacks when your payment stub shows an unexpected deduction. Trying to game the system by limiting your hours or hiding income can backfire, triggering audits, or even benefit suspensions for willful misreporting. Even moving to a different public agency can reset your earnings clock, requiring fresh calculations and introducing new caps you didn't factor into your budget. The emotional sting comes when you realize your carefully planned supplemental income actually hurts your bottom line, forcing you to choose between a lean lifestyle or abandoning work altogether. That's why anyone considering part-time work after retiring from a public pension must first run the math on every potential dollar. Because in too many cases, the extra check you thought you earned vanishes, and what was meant to boost your retirement instead ends up docking it. And if you believe you've unlocked all the clauses, wait until you see the deadlines that can lock in or wipe out your lump sum election forever. Many pension plans offer the option to take a one-time lump sum payment instead of a lifetime annuity, but the catch is that you usually have a very narrow election window, and missing it can lock you into a lower guarantee forever. That window often falls around your termination date or around a specified age, say 6 months before or after your official retirement date, and once it closes, there's no going back. Imagine you thought you'd wait until tax season was over or until you talked it over with your financial advisor, only to realize weeks later that October 31st was your deadline and you're now stuck with an annuity schedule you didn't want. Worse still, the lump sum amount is often calculated using actuarial assumptions that favor the plan sponsor. Mortality tables, interest rate assumptions, and cost of living adjustments baked into the formula can leave the lump figure well below what you'd need to replicate the same income stream on your own. And if market interest rates have fallen since you first became eligible, the lump sum value shrinks even further, meaning retirees who procrastinate see their cash option erode without warning. There are horror stories of participants who, after waiting until the last minute, received notices that the lump sum window had already closed. Others accepted a reduced lump option because they were told they could get it later, only to discover that subsequent rounds of open window elections either never materialized or were offered at even less favorable rates. Even when plans allow a small extension for extenuating circumstances, those are granted at the plan administrator's discretion, never a guaranteed right. The emotional weight of this choice is heavy. A lump sum gives you control and flexibility, but if you misjudge your decision window, you lose both that cash and the chance to negotiate better terms. That's why it's crucial to mark your election deadline on the calendar the moment you become pension eligible, run side-by-side projections of annuity versus lump sum under various market scenarios, and, if possible, get a written confirmation of your deadline from HR or your pension representative. Because once that election period passes, it's locked in forever, and the only payout you'll ever receive is the one the fine print intended all along. Some pension plans include a hidden power for plan sponsors to cut or suspend benefits whenever the fund's health falls below a certain funding threshold, and those provisions can strike without warning. Picture this. You've been receiving your monthly check faithfully for years. Then one day you log in and notice it's been reduced by 20% because the plan's actuarial report showed a dip below the 80% funding mark. That's exactly what happened to members of several multi-employer pension plans during the last market downturn. As stock markets slid and interest rates shifted, funds that once looked robust suddenly fell into critical status, triggering automatic suspension of cost of living adjustments or outright cuts to base benefits. Some plans even allow a complete freeze on payments until the funding ratio rebounds, a process that can take a decade or more if investment returns remain low. Even single-employer plans aren't immune. Underfunding triggers can be embedded in an agreement as a way to protect plan sponsors from escalating liabilities, giving them the right to delay benefit increases or reduce future accruals when contributions fall short. Retirees share stories of being told, "We're only using the authority in the plan to keep it solvent," while watching their lifestyle budgets suddenly shrink. And since these clauses are framed as emergency funding measures, participants often assume they're temporary, only to find that adjustments can stay in place until a formal funding improvement plan is approved, which can stall for years in volatile markets. What makes this clause particularly dangerous is its opacity. Annual benefit statements may note a possible suspension if funding dips, but few retirees parse that language. By the time a cut takes effect, it feels like a betrayal rather than an agreed-upon provision. The real shock comes when you learn that restoring full benefits isn't automatic. Plans must demonstrate a sustained funding recovery, file amendments, and sometimes even secure regulatory approval before reinstating suspended payments. That's why anyone relying on a pension with underfunding triggers must dig deeper. Ask for the exact funding thresholds, understand which benefit components can be suspended, and check the plan's recent funding reports. If your pension is under management by a struggling sponsor or part of a multi-employer structure, consider diversifying your retirement income to buffer against sudden plan-imposed cuts. Because in the world of hidden pension clauses, the greatest risk isn't market swings, it's a rule you didn't see that can quietly slash your check when you least expect it. Retirement planning often feels like a carefully choreographed performance, each step measured, each benefit calculated to the penny. Yet hidden in the fine print are clauses powerful enough to upend even the most meticulously plotted income stream. From COLA caps and freezes that can leave you footing the bill for rising living costs, to early retirement reduction factors that carve permanent discounts into your check for every month you dare collect, just a little early, from survivor and spousal offsets that pit your income against your loved one's security, to earnings and Social Security clause that quietly dock your pension for modest side gigs or guaranteed federal benefits. From lump sum election windows so narrow that missing the deadline locks you into an annuity you never wanted, to underfunding triggers that empower plan sponsors to suspend benefits when funding ratios dip, each of these 6 clauses hides in plain sight, waiting for the moment to strike. The common thread is this: failing to spot and stress test these provisions can mean waking up one morning to a smaller check, a tighter budget, and no easy appeal. But armed with knowledge, you have a choice. You can demand clear illustrations of every percentage cut and conditional freeze, run lifetime income projections under every scenario, and set calendar alarms for every election window. You can consult pension experts, pore over actuarial reports, and even build supplemental income cushions to insulate against sudden plan actions. Because in the end, a pension isn't just a promise. It's a contract you've already signed by meeting eligibility rules, and those buried clauses are as binding as any signature. Your comfort in retirement depends on reading every line, asking every question, and turning hidden triggers into agreed-upon decisions. Otherwise, your golden years could become a series of unwelcome surprises delivered in the mail with an explanation that begins as per plan provisions and ends with a smaller benefit than you thought you'd earned. Don't let that be your story. Dig into the details now so you can collect every dollar you deserve.